Give it up for Danielle DiMartino.
Danielle DiMartino.
Danielle DiMartino Booth.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Danielle DiMartino Booth, CEO and Chief Strategist for QI Research, former Fed insider, and also the author of the book Fed Up. Danielle, thanks for joining me today. How are you?
It's great to be back with you, Tom. Thank you for having me.
It's always a pleasure to speak with you, Danielle, and I'm sure today is not going to be any exception. You know, we were just remarking before we hit record here today about how insane the news flow really is and how it's so difficult to make any real evergreen interviews at this time. But, you know, I think the best we can do is really identify what's really pushing on either side of the scale here and try to, you know, wrap our minds around what are the most important things going forward here. So one of the things that I wanted to start with is just asking you if we're possibly going to actually end up getting a recognition of the recession that many have, you know, recognized as starting months ago. Do you think that we're actually going to get a real admission of that from official channels, let's say?
I mean, I think the first question that you ask is really the most critical one. At QI Research, you know, we originally started out envisioning a quote unquote research revolution. And, you know, over time, we've continued to look at data points and research that other people don't necessarily follow closely, but our mantras, it shifted. It shifted to trade the narrative, own the truth. Because how markets trade have absolutely nothing to do with the truth in the macroeconomic data. And the reason I bring this up is because with a May 7th release from the Bureau of Labor Statistics, we now know definitively, and this is not Danielle conjecture, this is not a hypothesis, this is just 12 million US private employers and the data that they have reported that show that in the 6 months ended September the 30th, there were net job losses that began in the second quarter of 2024. And, you know, what we know and what any official, to use your word, what any formal economist would reiterate and tell a young student of economics is that job losses always begin after recession has started. Meaning, if we know that job losses began in the second quarter of 2024, then we know definitively, again, this is not an opinion, this is not a model, this is not my hypothesis, but we know definitively that recession started in the first quarter of 2024. Now, recognizing that is a real head twister. And I only say that because if we recognize when recession began, then it sort of becomes a political hot potato, because then you're saying, you know, and there's been a lot of criticism of the prior administration, not because of the prior administration's politics, but because in the history of US data, we've never seen revisions of this magnitude to payrolls in an economy that is 70% consumption, when aggregate income determines where you are in an economic cycle. But again, I go back to the narrative. I go back to our new mantra at QI Research: trade the narrative, own the truth. So if you know that recession began in the first quarter of 2024, at least you know where you are in the cycle today. And I think that that's what any investor worth their salt needs to know, because you need to be able to determine, how am I going to invest from this point on, given what I know from the past, given, you know, the Bureau of Labor Statistics originally reported this data. Great, wonderful. It was based on models and very low survey response rates. Now we've heard from 12 million US employers. We know for a fact that they started destroying jobs in the second quarter of 2024. Where does that put us in the cycle today? Because we're more than 1 year out from that point. And you really, really have to know that. It looks like the data improved in the final 3 months of 2024. And judging from 4 back-to-back months, almost 5 back-to-back months of job cuts north of 100,000 in the private sector only, plus what we know Elon Musk did before he returned to the private sector, which is 260,000 some odd federal layoffs. Knowing what we know about 2025, we think that the United States economy may have come out of recession ever so briefly in the fourth quarter of 2024 and gone right back in. So that's kind of where we stand today. Does that have anything to do with the headlines and the news flow and the way that markets are trading? Absolutely not. But again, from the perspective of an investor, you need to know where you are in the cycle, regardless of how markets are trading, so that you can look to the future with some information in hand.
Absolutely, Danielle. And what does this have to do with the old definition of 2 consecutive quarters of negative GDP? I know job losses are very alarming or affect a lot of people very negatively and the economy, but is that basically a direct translation into negative GDP growth?
To answer your question, yes.
Mm-hmm.
Now, we saw 2 consecutive quarters of negative GDP in 2022. We shrugged them off. 2022 also happens to be a time that job creation was ongoing, that wage gains were very strong, such that the National Bureau of Economic Research was able to say, due to some trade war math and tariffs and supply chain disruption and inventories swinging this way and the trade deficit swinging that way, we were not in truly what we consider to be a recession in the United States, even though in any other country on planet Earth,
mm-hmm.
that would have marked a recession. As far as going forward, because the NBER now has official Bureau of Labor Statistics data in hand, the NBER now knows that recession began in the first quarter of 2024. Whether they acknowledge that or not, that comes sadly down to politics. And I recently tweeted out that Truman is spinning in his grave because the NBER was established during his presidency. So it has a very long, rich history of being forthright about dating economic cycles. So if the decision, and I'd say that word carefully, if the decision is made to not recognize when recession began, that will be the first time I think that you will have kind of a pure stain of politics and partisanship on the track record of an organization, an institution that has had really no stain on its reputation since Truman was in office. So in the post-war era, if you will. Going forward, though, a lot of things begin to make sense. And the election makes a lot of sense, right? If we were in recession starting in the first quarter of 2024, well, then by golly, by the time November rolled around, of course, Americans were ready for change because they were in recession that was being denied by the politicians and the media. So of course we were ready for that change, but now we've slipped back in. So where does that put the mindset of small investors, big investors, and the voting public? And these are all very viable issues that have to be explored because, before you and me know it, we'll blink and we'll be at the midterm elections.
Mm-hmm. Yeah, that's a great point. And it kind of brings up to me this idea that, if as you brought up, the idea that there were people that were very critical of the previous administration for, having revisions and maybe, let's say, manipulating data. And I always come back to that idea of not necessarily supporting a particular policy decision because your team has the power to do it. At some point, you have to realize that the other team that you might be against has the power to do the same thing. And I think that's such a useful lens to look at many of these situations through.
I think that that is a very wise takeaway from all of this, is that we've seen something extraordinary in 130 years of history. It's been that long. And I bring this up, Tom, not to be hyperbolic, but the last time we saw the White House change parties 4 presidential elections in a row was the Civil War. And we have to look back on and respect, I think, a public that keeps voting with its wallet, because it's always the economy stupid. It is always the economy stupid. It was the economy. That's why the White House changed hands again in 2024. And the risk is now, if there is a continued denial, if the powers that be in the media want to potentially see this administration run itself into the ground, and therefore they're going to do what they can to help the Federal Reserve stay on hold and not provide relief to the U.S. economy when it's needed, when the Fed is failing on its employment mandate. If that's going to be the case all over again, then we're going to have yet another switch in leadership. And the pendulum's just going to keep swinging from one extreme to the other. Every executive order that we've had to keep up with in the news flow is just going to be reversed. Mm-hmm. You'll see the pendulum swing right back to the other side.
Just to play devil's advocate there, Danielle, the Democrats at this point seem to be a party with no leadership. And,
yeah.
I mean, point taken about the swing from left to right and back. But if your party has lost a lot of credibility and you have no reasonable leader, I mean, unfortunately, we've gotten to a place, both in my country and in yours, where we don't have, pardon the language, but we don't have good quality leaders to be able to actually choose from.
Well, so this is what I would say. It's very easy to win a midterm election because you're not necessarily searching for that one individual who is going to represent the leadership of the entire party. In other words, there's enough time to get the American public angry all over again if they're gaslit again, if they're ignored again, if the recession that we're back in because of job losses is disregarded anew. I would argue that there's enough time for somebody to rise up into a leadership position between now and November of 2028.
Mm-hmm. Yeah. And I mean, setting aside the idea of the popularity contest that the presidency seems to have become, I think we as a society really need to get back to being able to have very good quality and competent leaders to be able to at least understand the problems that we're facing.
Well, I mean, look, again, you're flaunting your wisdom today, and in the best way, because, as a people, it gets really old to be lied to. Mm-hmm. And, when you're talking about legislation that is being called fiscally conservative, when all it's going to do is blow up the deficit even more. Again, your average working man, your average working woman, they know that they're being lied to. They know that if deficit spending is going through the roof, that you can say whatever you want on the Sunday morning talk show circuit to talk it down, but that the government continues to spend money like a drunken sailor, regardless of which party's in a leadership position.
So, Danielle, getting back to how this actually affects, policy, what is actually happening here, considering the gigantic consumer that the US actually is for the rest of the world, is the rest of the world actually, in danger of going into recession as well?
Well, the answer is yes. The U.S. consumer is 18% of global GDP.
Mhm.
So when you consider the fact that that everything you're seeing right now about student loans coming home to roost and mortgage refinancing application rates, rejection rates being 42%. When you're talking about buy now, pay later being reported to the TransUnions of the world by the Klarnas of the world, when you're talking about auto loans being very difficult to access and credit card borrowing rates still being in the 20-something% range, while people like Jamie Dimon are pushing up charge-off rates, everything I've just described to you is a credit crunch. And credit is being curtailed to US consumers, and US consumers, I repeat, are 18% of global GDP. So it's a real problem that credit is impaired, to small businesses and to US households.
Yeah, it makes sense that, if you look at that source of demand starting to wane, starting to get crunched by all of these different, pullbacks in availability of credit, that is obviously going to have these downstream effects. And you mentioned this idea of the student loan forbearance. I'd like to dig into that a little bit and understand how and when this is coming to an end and what that actually means for those that had the time to put that off as well.
So from what we know, there are about 5.4 million or so borrowers out of the 44 million student loan borrowers in the United States. There are about 5.4 million who have not made a payment in more than a year. And only about 50% of them have been reported. So only about 50% of that group has had their credit impaired, their FICO, their credit score come down, which means that by the time we get to the end of the current quarter, they will also, that second 50% that has not been reported will be reported. So we're talking about a month from now that their credit begins to be impaired. So whether they're trying to, and we're seeing all kinds of stories, whether the national media is all over this story. So whether you're trying to buy a car or refinance your mortgage, and you find out the hard way, wow, my credit score just fell out of bed. You're not going to be able to finance not just your spending, you're not going to be able to finance your obligations. And that's a whole different dynamic than anything we've been used to, when the only thing of substance that we can see the quote unquote big beautiful bill accomplishing is the prevention of a negative income shock at the end of 2025 if tax rates don't go up. But that has nothing to do with being $100 billion shy of the $15 trillion in spending that's occurred post-pandemic that was pumped into the US economy in the form of stimulus. We're not talking about anything in that form. Nothing. We're talking about the opposite thereof. And I've asked people in public, I've asked people in private, I've asked clients, I've put open questions out on Twitter. What is going to offset the massive wave of home equity cash out refinancings in the 2000s? What's going to, what replaced that? We know that was student loans. And it went from like 10% of disposable income to 9% of disposable income. 10% was cash out refinancing. Student loans peaked at 9% of disposable income. And then came the CARES Act and unemployment insurance and the rental eviction moratorium and trillions of dollars in borrowing, in addition to the $15 trillion that the US government spent, much of which was directly deposited into checking accounts. But I have asked the open question to everybody I'm going to start stopping people on the street and asking them, what's going to replace that? And nobody can answer that question. I have yet to have anybody even attempt to answer that question because, again, the only thing that Congress is contemplating is the extension of tax cuts to prevent a negative income shock. They're not talking about sending out a $1,300 or a $2,000 stimulus check to every American or directly depositing that into people's bank accounts. It's exactly the opposite. We're talking about the curtailment of credit to U.S. households. And again, nobody can tell me what's going to replace this. So this is where, the Federal Reserve comes into the discussion.
Well, before we get there, because there are so many of these forces that are pressing on each side of the scale, and again, we really need to be able to kind of sort all those out. Danielle, one of the other things that I really wanted to speak with you about is the commercial real estate bubble that has loomed over us, and doesn't really seem to have materialized in any reasonable losses for the banks or anything like that. Why is that?
So, it's so interesting you asked this question, because we've just had kind of the first shot across the bow. Lord Abbott, ABBETT, there was a headline that crossed that basically said they ate a $253 million loss on a commercial real estate investment through through a securitization, a commercial mortgage-backed securities. I don't think that's going to be the last recognition that we see. And it is indicative of the fact that as much extending and pretending as we've seen, I think that is also coming to an end here. And that we're finally, to your point, going to begin to see not just this building changed hands for so much less than it did 6-7 years ago, but this investing entity just realized a $250 million loss on that investment. This is when the proverbial rubber hits the road, is when you start to see loss recognition attached to investors. And there's no denying that. And bank regulators have arguably given way too much grace to lenders. But it's looking like those times are ending again. The Federal Reserve has only lowered interest rates 100 basis points. That is not near enough to bail out the commercial real estate industry. And it looks like it's the case that regulators are also starting to press forward on loss recognition. And that will be, you're right, yet another complicating factor when you're trying to take in the entire lending backdrop. Because what we started talking about today was just the U.S. household, just U.S. consumption. Now you've brought in the element of the banking sector. And when you bring that in, all that tells you is that the feedback to the household sector is going to be even worse. Mm-hmm. More losses are recognized, the more impaired credit becomes to all lenders.
Well, I mean, exactly as you're explaining that, I flash back to that saying of, if you owe the bank $1 million, it's your problem. But if you owe them $100 million, it's their problem. And of course, they're going to be graceful to try to let, you pay down the debt that you took out in order to service that loan, and not want to recognize that loss and actually, put it on the books. And it just seems like there's so many of these, let's say segregated baskets, if we think about them that way, that are adding up. And, you brought up the idea of the residential sector as well. I think you said before we hit record again that this is the first time since 2022 that we've seen negative prints in home values?
Yes, because every month we get two big indicators. The FHFA is one of the data providers, and S&P CoreLogic is the other kind of standard go-to home price indicator. And both of those metrics showed losses month over month, losses in home price appreciation. So actually home prices declined month over month. And these are very, very long lagging indicators. So the data that's fresh in hand is from the month of March. So what we know is, from what we've seen from Redfin and other providers of real-time weekly data on housing transactions, is that things have just gotten worse since March. That transaction volumes have declined further. And that means that March is going to be the first of many home price declines on a national level. Of course, it's going to be worse in the Sun Belt initially, but we're already seeing distress climb up into the Midwest, and it will end here in the Northeast of the United States. I'm in New York right now where I'm filming, but it will end up here eventually. And again, add that to the laundry list of things that we're describing that's going to make record levels of home equity that Americans have built up in their homes inaccessible. And we are a consumption-driven economy. The ability to cash out the equity that you've built up in your home it's only accessible to the extent the bank is going to lend it to you. And if banks start to see coming across their desk, as loan officers begin to see home prices declining on a national level, they're going to take a second look at that appraisal value. They're not going to lend you what you want. They're going to reject your refinancing application outright, especially if you've just been hit by buy now, pay later, hitting your credit report for the first time since it existed as a type of loan, especially if you're found out to have not made a student loan payment for the last 5.5 years. All of that's going to make it that much more difficult to access the equity that you've legitimately built up in your home value. Even if you want to take a big 25% haircut, call it what you will, there's still going to be effective wealth that cannot be monetized in an economy that relies on debt-financed borrowing to fuel spending.
So Danielle, these topics that we've covered already seem to be in the, let's say, very negative side of, let's say, the Fed's purview. All of these ideas seem to lend themselves to an idea of going back to QE and slashing rates. But on the other side, we have this tension between what basically the tariffs are doing and what the ramifications of that could be. I saw a report the other day that said container shipping from China is down 44% right now, year over year. So how do we see inflation basically going forward from here, especially, goods price inflation? For now, let's leave the housing component out of it. And could this create a stagflationary environment for the vast majority of Americans?
In theory, that would work. In the years 1975 to 1979, before you were even a twinkle in anybody's eye, aggregate employment levels in the United States were rising. Mm-hmm. And thereby, the oil embargo and the supply crunch for energy that existed then, because aggregate employment levels were rising, OPEC was able to pass along those increases at the gas pump prices. Mm-hmm. What we're seeing now is that goods pricing is indeed occurring. We're seeing rising prices for goods in pockets. At the same time, you've got the Home Depots of the world coming out and saying, we can't raise prices. We can try. We're definitely shouldering higher input costs, but we can't raise prices. And we're seeing the tension that you describe because Americans, in order to spend more on goods, are being forced to spend less on services. I was just in Las Vegas, to one example. Mm-hmm. I've been going to Las Vegas for conventions and what have you for decades. I've never walked out of the airport and straight into a taxi without at least waiting a few minutes for a taxi cab, but I didn't. I walked straight up to the cab and got straight into the cab. Mm-hmm. Year over year, tourism traffic to Las Vegas is down. Unheard of. Nevada is the highest intensity state in the United States in terms of the state's economy that relies on tourism to fuel that economy. And yet traffic is down year over year in Las Vegas. So yes, companies can endeavor to pass along higher input costs, and they can want to. If they don't, in some cases, they'll do this thing called going bankrupt. If they cannot establish pricing power, but what the US household is telling you right now is, if I have to spend more on goods, I'm going to spend less on services.
Mm-hmm.
So I'm canceling my vacation. I'm not buying that airplane ticket, or I'm driving with my family this summer instead of flying. We're going to stay with relatives, not in a hotel, because the budget doesn't work unless the budget works. And if American families have to pay more for goods, then they're going to spend less for services. And that will be a greater drag on the CPI than goods inflation will be, because Americans spend much more on services than they do on goods.
Mm-hmm. And that's a perfect time to put housing back into it. If housing prices are falling, or let's say shelter, right, that ends up being the biggest component of CPI as well, right?
That's absolutely correct. And that is why we're seeing so much push and pull. We've seen apartment rental rates coming down for months and months and months. And in fact, what's been kind of bizarre is to watch the multifamily developers who still have access to financing building more apartments. You can feel the home builders in the United States cringing, mm-hmm. because now you have the price of a new home equal the price of an existing home, which it really never happens in the United States. I bring that up because if you're trying to rent an apartment and a new home costs as much as an existing home, you better be lowering that apartment rent even more. And what you end up with, Tom, and the reason I bring this up is you end up with rental disinflation feeding into housing disinflation. They both feed that shelter component of the CPI, the biggest input by far. Mm-hmm. And at the same time, you've got hotels going belly up because people aren't staying in them. And you've got Airbnb jocks desperately trying to sell their properties because people are simply not paying up. We've had inflation-adjusted incomes declining since September of 2024. That's just a fact. Mm-hmm. When you have inflation-adjusted aggregate income declining, you're going to have to spend less on something if you're spending more on something else that you consider to be unessential, i.e. food on the table. Mm-hmm. So if you're spending more to feed your family, then you have to spend less in some other area if your income is declining. It's a fact of life.
Mm-hmm. Well, and going back to your previous example of Home Depot not feeling that they're able to raise prices, it makes me think of these other businesses like, let's say Walmart, for example, that operates on these razor thin margins. And if their input costs start to rise, that cost has to be shouldered somewhere. And I think I read recently that they just laid off 1,500 more workers. So, this isn't, unfortunately, it just doesn't happen inside a vacuum chamber, right?
It doesn't. And in fact, the media seized upon, Walmart's going to be raising prices, blah, blah, blah. Well, yes, but the CFO also said, we know we're not going to be able to pass along all of the price increases on the same exact conference call that he said that they're going to try to raise prices. But we have to take everything in the context, right? Mm-hmm. This was followed up by 1,500 layoffs. So these individuals who used to work at Walmart, they don't have an income. They don't have falling aggregate income. They have no paycheck. Mm-hmm. So you see what just happened to their purchasing power. And at the same time, we know that a huge percentage of higher income Americans have already traded down to Walmart to begin with, to be able to afford essentials. Walmart's already tapped into that higher income consumer because that higher income consumer has already had to trade down. And again, we're talking about the same exact demographic of people with the largest student loan payments. None of this is unassociated. You cannot divorce any of these subjects from each other. You cannot explore any of them in isolation because, to your point, it's all interrelated. So whatever Walmart's going to have to swallow in terms of margins, it's going to come out of their headcount.
Mm-hmm. And I would think that that's also going to end up in the data quicker than something that you and I have talked about before, is that severance pay that doesn't make the lost jobs actually show up right away when they're actually canceled, right?
That is true. In fact, it was interesting. Bank of America, of all entities, just put out a graph. I tweeted it out earlier today that shows that higher income Americans right now are seeing the fastest uptake of unemployment benefits. So this is your point. And that means that they're not on severance anymore if they're applying for unemployment insurance. And again, this is the highest income tercile. If you were to split incomes into three buckets in the United States, it's the people who make the most. It's the white collar workers who are applying for unemployment benefits the quickest, which is something that we've been seeing in declining Uber weekly pay, meaning I have to apply for unemployment benefits because I can't make as much money as I need to driving for Uber because so many people have flowed into that particular part of the workforce. But we still haven't seen what's to come. To my point about midterms and a long time for the leader in the Democratic Party, whoever that person may be, has plenty of time to rise up because severance for federal employees doesn't end until September. And then you'll have that cohort that Reuters estimates 260,000 federal employees have lost their jobs. We had Bain Consulting come out a few days ago. And I believe it was Bain. I might have the wrong consultancy, but we had a huge U.S. consultancy that relied on government contracts come out a few days ago and lay off 1,500 people. The shocks have to somehow be absorbed. And what we're going to see again at QI Research, we think the United States went into recession in the first quarter of 2024, came out of it in the fourth quarter of 2024 and went right back in, which, by the way, that's a repeat of 1980, 1981, when Ronald Reagan came into office. Jimmy Carter had built up the federal workforce when he was in office for 4 years. Ronald Reagan came in and slashed federal headcount, one of the first things he did. And boy, the economy went right back into recession. We think we're seeing a parallel move right now in the US economy, that it went into recession, came out, and went right back in.
So Danielle, from the Fed standpoint now, how does Jay Powell look at absorbing some of these shocks? Because, you know, we've finally gotten a little bit of visibility on what tariffs look like they're maybe going to be for today or tomorrow, right? So how is the Fed looking at this point?
Well, I think that the Fed has to, first of all, step back and acknowledge, and this, by the way, the probability of this happening is 0 to none. I don't think anybody's having any fantasies anymore that Jay Powell has any love lost for Donald Trump. So I don't think he's going to lift a pinky finger to help him. But a more responsible Federal Reserve would recognize the Bureau of Labor Statistics revisions data that came out for the third quarter of 2024 that definitively shows that the U.S. economy went into recession and that therefore the Fed was failing on its employment mandate. Now, for the Fed to recognize that, though, they'd have to do something about it. And for the Fed to recognize that shelter inflation, even though these are national economic data statistics that have come out, this is not some S&P CoreLogic, the FHFA. These are national entities that are reporting declining shelter costs. This is not some obscure piece of data that Federal Reserve PhD academics don't have any access to. They've got access to it all day and on Sunday. For the Fed to ignore all of this and fall back purely on the threat of tariffs raising goods prices, it's pretty disingenuous. It's beyond disingenuous at this point, especially because they have the example of 2018, 2019, when the transcripts of the FOMC meeting for 2019, they were released in mid-December of 2024. Those transcripts walked us through every single meeting in 2019 when Federal Reserve officials eventually acknowledged that the depression in growth, the drag on GDP was greater than any inflationary impulse created by the tariffs that were started in 2018. That is the Fed's own experience. So the Fed right now is, I don't use these words to be inflammatory. I use them to be precise. The Fed is derelict in its duty right now because it's not acknowledging Bureau of Labor Statistics data about payrolls. It's not acknowledging shelter disinflation. And it is not acknowledging its own experience in 2019 with the tariffs. So ignoring those three things right now is putting the Fed in a position where it is truly derelict in its duty to make monetary policy in quote unquote the public interest, which it is not. It is making monetary policy against the interest of the White House. And that is not the Fed's role. The Fed is supposed to be apolitical in making monetary policy, and it is absolutely not by pretending that the data are something other than what the biggest data providers in the country and official channels are telling them.
So it seems like the Fed at this point is maybe ignoring the reality that is, and as many people have pointed out before, just, maybe worried about being prompted to act in an actual crisis situation, which, being ahead of the ball instead and acknowledging and being actually data dependent, as we've heard Jay Powell say so many times over his term, you would think that they would be recognizing these trends that are only accelerating.
So to your point, the Fed is no longer data dependent because they're ignoring data. Mm-hmm. And they're not ignoring soft survey data, waiting for hard data. They're ignoring hard data.
Mm-hmm. So Danielle, you mentioned earlier, investors need to be looking at basically the world that is rather than the world that they want, right? So where do investors not hide their assets at this time, but what kind of assets work in an investing environment like this?
So as one of my institutional clients pointed out to me today, the fact that in this economic environment, you can still get north of 4% on your cash is unbelievable. Now, don't get me wrong, this person's only been investing for 40 years. So maybe he's a little wet behind the ears. But to hear somebody with that caliber and that level of experience be incredulous that in this environment you can still get 4%. And the point was, if the Fed is going to completely ignore the hard data that are staring them in the face and maintain interest rates at artificially high levels, lock those rates in. Lock them in for the next 12 months, because when the Fed is as derelict in its duties as it is, and when we know that, 260,000 federal employees severance is going to be running out as of September the 30th, you can look out over the horizon and say, this is when the policy error that the Fed is committing currently is going to come back and bite them. Mm-hmm. And then they're going to be playing a mean game of catch up, hoping that they've waited long enough to bury the current administration. And bear in mind, I didn't vote for Donald Trump, and I will say that out loud. I did a write-in candidate. I voted for Jesus, but no lie. But I'm not saying anything for or against the current administration. I'm saying that the Fed is being very blatant in making monetary policy to harm the current administration. And when you are making decisions through that prism, saying with utter insincerity, we can't lower interest rates because we're concerned what tariffs are going to do to inflation, despite all of the other evidence to the contrary, that disinflationary forces are kicking in hard, i.e., tourism to Las Vegas down year over year, shelter inflation falling on a month over month basis for the first time since June of 2022 in two major surveys, two Bureau of Labor Statistics data that show you that in the 6 months ended September the 30th, 2024, there was a net 3,000 jobs destroyed beginning in the second quarter of 2024, meaning every single economics textbook on planet Earth tells you that job losses commence after recession has begun, such that you know that the recession began in the first quarter of 2024. If the Fed's going to ignore all of this, then when they do have to come riding to the rescue of the economy, it's not going to be pretty. It's not going to be measured. It's going to be panicky.
Mhm. I appreciate, Danielle, you putting the timeline based on getting let's say a nominal return of 4% right now, because that's something that, on the show that I always think that we need to go through is kind of clarifying these types of timelines for investments, because it's so easy to misunderstand or talk past each other on that. Because if you
there are defensive stocks, there are defensive postures that you can take. There are companies that are going to continue paying their dividend come hell or high water. What you lose on the capital side, I don't know. But if you're absolutely 100% convinced that either a bond payment, a coupon payment, or a dividend is money good, fine, own it, sleep at night.
Mm-hmm.
If you need to have exposure to super risky assets, fine, buy crypto and just put whatever percentage of your portfolio in that. But again, in this environment, you're being paid extraordinarily well to be safe. And this is an unusual environment with net job losses in the United States of America and a Federal Reserve sitting on the sidelines. It's an unusual backdrop that any rational investor would be taking advantage of, given the stock market's basically where it was on election day. You've taken a wild ride, or you could have just clipped a coupon.
Yeah. And my point was only going to be is that, your real rate of return needs to be kept in mind, because if you do hold, that coupon for much longer, that visibility isn't necessarily going to be as good as, what we have for the next year, as you said.
That is true. On an inflation adjusted basis, it should actually improve. But again, the idea is to lock it in.
Mm-hmm. Absolutely. Danielle, I think that's a good place to kind of end today's interview. Is there anything that you'd like to leave our listeners with to think about before we do?
So the only thing that I would add right now, and this is what I've been saying at the end of all of my interviews, is in a time of net job destruction, there will always be opportunities to be had, especially when it comes to being kind to one another and charitable to the extent that you can be. That is my personal plea, is that we are living in an environment where you need to be aware of your friends, families, and neighbors and where they are in this economic cycle, especially if the entities and institutions who are supposed to safeguard their essential needs are ignoring them.
Mm-hmm. That was really well said, Danielle. I don't think we have anything without community especially in times that can be even rougher than what much of the American public is already experiencing.
Absolutely.
For those that want to hear more from Danielle, always an excellent Twitter follow at DiMartino Booth, DiMartinoBooth.substack.com, and of course, QIResearch.com. Danielle, thanks so much for your time today. Always a pleasure.
And thank you for having me, Tom. Take care.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.